I think it's interesting. We know about where we sit today, which is probably in a recession at this point. That's all the data that we got this week really confirming that. And we know that we're building bridges to the other side. That's why the market had such a positive week this week. We had that fiscal response, we had the monetary response. The issue, I think, and that leads us to think volatility might stay high, is that we don't know how long it'll take us to get to the other side, meaning how long we will be in this state where COVID-19 cases are rising and hence where we have restrictions on economic activity. In terms of the fiscal package, this one, $2 trillion, 10% of GDP, it'll help. But if this goes longer than we expect, then we might need to see more.
Scott, do you feel now that whether it's Treasury, whether it's Congress, or whether it's the Fed, that all of the sort of financial, technical plumbing factors have been addressed, and it's just a case now of watching the fundamental numbers in terms of cases and deaths of coronavirus?
Well, certainly the Federal Reserve, they took out the bazooka. Congress took out the bazooka. Now, with Congress, you have to wonder, is this money, is this going to be efficiently and quickly deployed to the places where it needs to go? And let's face it, this is not really stimulus. This is a relief package to hold the economy in until we do get to that other side. Now, from our side, our opinion is that the Fed still can do some things. Certainly, Jay Powell thinks that the Fed can continue to do some more things. Congress is already talking about, you guys have done numerous interviews with members of Congress, and they are already talking about coming back and doing more. So I think that those are two positives for the market. But certainly, if we're all staying at home, sitting in our home offices, you guys have been broadcasting and anchoring shows from your home or your apartment. And, if that drags on, that's going to be a big problem because, let's face it, the economy is driven by consumer spending. We need some confidence. There's going to be some pent-up demand that will eventually be released. We do think we'll see some positive GDP in the fourth quarter and some better things going on in 2021. But, certainly these first three quarters, we're looking for contraction, negative numbers, especially the second quarter. So we have some things to get through, but at least we have a good foundation here that will likely cushion the blow and help us get to the other side.
Yeah, Gabriela, what do you think is in the market in terms of expectations for economic declines now that we do have the $2 trillion relief package from the fiscal authorities and the Fed stepping in a major way as a lender and buyer of last resort?
Sure. So I think the market is expecting a very, very bad second quarter here for GDP. Estimates are still a little bit all over the place, but double-digit contraction, I think, is very much expected, with an accompanying earnings recession, which is slowly being reflected in earnings expectations. Now, I completely agree that this is not fiscal or monetary stimulus. It's really not going to, unfortunately, be able to prevent that double-dip contraction. Now, what we're still all trying to figure out is what the second half looks like, and we absolutely have very, very little visibility on this. So I think there's a desire to be hopeful that the second half is going to be better, but we really will have to continue watching the growth rate of the new COVID-19 cases to be able to gauge this. It's very hard to model the evolution of a virus, of a new one, and one that's being reacted to so differently around the world.